Everyone's talking about how the Bank of Japan's interest rate hike will kill the Nikkei tech rally. But here is the number nobody is mentioning. Japanese corporate cash reserves hit a record 275 trillion yen last Friday. That's not a graveyard, it's a war chest.
Wait, 275 trillion? That's nearly 5 times the market cap of NVIDIA. If that capital starts flowing into AI infrastructure and R&D, we aren't just looking at a recovery, we're looking at a complete structural takeover.
Exactly. And welcome back to Asia Tech Macro. I'm Alex, former hedge fund analyst and your resident professional skeptic, joined as always by Maya, who brings that move fast and break things startup energy to my slow down and count the money vibe.
Someone has to keep us looking forward, Alex. But seriously, today's episode is packed. We're analyzing the aftermath of the BOJ's January 23rd decision, the brutal HBM4 yield wars between the South Korean giants, and a deep dive into the ghost supply chain that most investors are completely misreading.
Let's start with the macro picture in Tokyo. I was just reading this morning that Kazuo Ueda held the line at 0.75% yesterday. The market was a bit split on whether he'd push to 1.0%, but staying at 0.75% was a surgical move. However, the guidance for late 2026 is what's really sending shockwaves through the Nikkei. They're signaling that the era of free money is officially buried, but they're terrified of choking off the semiconductor revival that's finally gaining momentum.
I was talking to a hardware founder in Tokyo yesterday, and the vibe shift is undeniable. For 30 years, Japanese tech was about playing defense, cost-cutting, shrinking, just trying to survive. Now, even with the yen strengthening slightly, they are playing offense. But Alex, let's be real. Doesn't a stronger yen eventually gut the big exporters like Tokyo Electron or Advantest? I saw their stock prices dip about 2.8% right after the announcement.
That's a knee-jerk reaction from retail traders, Maya. It's a distraction. Let me rephrase that. Investors are looking at the wrong indicator. In 2022, you bought Japan because it was cheap. In 2026, you buy Japan because it is the only reliable high-end alternative to the China-centric supply chain. The TSMC Kumamoto Fab 2 is already ahead of schedule. Efficiency and geopolitical stability are the new currencies, and Japan is currently the wealthiest nation in the world when it comes to those two assets.
That reminds me of what happened in the early days of the Shenzhen boom, but with actual intellectual property protection. But okay, let's move to the real drama, the memory throne. I saw the preliminary earnings from Samsung that dropped last week, a 900% jump in operating profit year over year. On paper, that looks like a total victory.
If you're reading the headline on a Bloomberg terminal in a rush, sure. But if you actually dig into the segment breakdown, it's a different story. Most of that 900% is just the commodity DRAM market bouncing off the bottom of a 2-year depression. It's a dead cat bounce in terms of high-level innovation. The real battle, the one that determines who owns the next decade of AI, is the HBM yield war.
Right, high bandwidth memory. I saw a note from Kenji Nakamura at Goldman Sachs yesterday. He confirmed that SK Hynix is maintaining a consistent 80% yield on HBM3E. Alex, you've looked at these cleanroom stats for decades. Is 80% even possible for a stack that complex?
It's basically black magic. To stack 12 or 16 layers of DRAM and have 80 out of 100 come out perfect, that is why SK Hynix is currently the only one Jensen Huang truly trusts with NVIDIA's flagship GPUs. Samsung, meanwhile, is reportedly still struggling to stay above the 55 or 60% mark for their 12-layer stacks. That's a massive gap when you're talking about billions of dollars in CAPEX.
And that explains the Hail Mary pass we saw this week. Samsung is reportedly trying to leapfrog directly to HBM4 by late 2026, skipping the iterative improvements their competitors are making. They want to integrate the logic and the memory on a single die using their internal foundry. It's the everything under one roof strategy.
It's a massive gamble, Maya. If they pull it off, they disrupt the entire industry and potentially push SK Hynix back to being a tier 2 supplier. But if they fail, if the heat dissipation or the logic integration fails at 2 nanometers, they might lose their lead in memory forever. Here's what most people miss. SK Hynix isn't just winning on tech, they are winning on co-engineering. They are designing their chips with NVIDIA's engineers in the room. Samsung is still trying to sell a finished product to a customer who wants a partner.
That's a huge distinction in the startup world, too. The difference between a vendor and a partner. But let me put you on the spot, Alex. If you're managing a tech fund right now, do you stick with the proven yield of SK Hynix even at these record high valuations? Or do you bet on the Samsung turnaround story?
I've seen this movie before. In 2015, everyone thought Samsung would dominate the foundry business because they had the cash. They didn't. I would stay with the yield until Samsung proves they can actually ship a 12-layer stack without the thing melting or failing stress tests. Beta testing with NVIDIA's money is a dangerous game.
Fair point. But speaking of dangerous games, we have to talk about the ghost supply chain in Southeast Asia. I was reading a report from CIMB Research this morning about Malaysia's data center boom. They're calling Johor the new Shenzhen of the South.
Johor? I mean, I love the ambition, but have you seen the power grid infrastructure in Malaysia lately? You can't run a 500-megawatt AI cluster on a grid designed for palm oil refineries and shopping malls.
Well, that's exactly where the friction is. Microsoft and Google just committed another $10 billion to Malaysia and Thailand combined. But they aren't just building data centers anymore. They are practically becoming independent power producers. Vietnam just passed a new decree on January 19th that allows direct power purchase agreements. It means these tech giants can finally bypass the state-owned grid and buy renewable energy directly from private wind and solar farms.
That is a total game changer for the green AI narrative. That reminds me of what happened in 2022 when corporate PPA laws started changing in Europe. It's the only way to satisfy the ESG requirements of the Silicon Valley giants while operating in a coal-heavy region. But here's the but, and you knew it was coming. Who is actually building these data centers?
You're leading me right into the ghost supply chain conversation, aren't you? I can see that cynical grin from here, Alex.
Guilty as charged. But look at the FDI, foreign direct investment data that hit the wires just 48 hours ago. While the mainstream headlines are screaming about American and European firms de-risking from China, the actual money trail shows something far more complex. In Vietnam and Malaysia, over 20% of the new tech investment in the last 6 months hasn't come from Silicon Valley or Berlin. It's come from Shenzhen, Suzhou, and Hangzhou.
Wait, really? So Chinese firms are effectively self-de-risking by moving their own assembly lines across the border?
Exactly. They are internationalizing to bypass the NVIDIA access surcharge, that 25% fee we've been seeing on high-end AI chips, and to skirt the potential 60% tariffs that have been a constant threat in the 2026 trade negotiations. They move the final 10% of the assembly process to a factory in Penang or Bac Ninh, slap a Made in ASEAN sticker on the box, and suddenly the geopolitical risk disappears on paper. But here's what most people miss. The high-value components, the specialized sensors, and the profit margins, those are still flowing straight back to the mainland.
That is a fascinating and terrifying thought for a compliance officer. It's like a hall of mirrors. You think you're investing in a China-free supply chain, but you're actually just investing in a more expensive, geographically distributed version of the Chinese ecosystem.
Precisely. It's a ghost supply chain. And speaking of ecosystems trying to compete with the ghost, we have to look at India. I was just reading this morning that Apple's latest internal report shows India now accounts for 24% of all iPhone production globally. That is a massive jump from where we were just 2 years ago.
24%? That's almost 1 in every 4 iPhones. I saw that Tata Electronics is planning a massive $11 billion expansion for their semiconductor assembly and testing plant in Gujarat. It feels like India is finally hitting that escape velocity we've been waiting for.
Okay, but let me play devil's advocate here, because I have to. Yes, the numbers look great, but I was looking at a note from Sanjeev Prasad over at Kotak Institutional Equities last week. He pointed out that while the assembly is moving to India, the component ecosystem is still remarkably thin. India's electronic imports are actually rising alongside their exports. It's a screwdriver economy for now. You're importing the brains and just doing the manual labor in India.
Screwdriver economy is a bit harsh, Alex. But you have a point about the subcomponents. However, isn't the scale the most important factor? Once you have the assembly, the suppliers are forced to move closer. I saw that Murata and TDK are already scouting locations near the Tata plants. That reminds me of what happened in the Pearl River Delta in the late 90s. First comes the assembly, then comes the world-class supply chain.
Maybe, but China had the advantage of a monolithic top-down infrastructure push. India is a vibrant, loud, and sometimes chaotic democracy. The infrastructure friction is real. I saw a report yesterday that the logistics cost as a percentage of GDP in India is still hovering around 13%, while in Vietnam it's closer to 9%. If you're a margin-sensitive tech giant, that 4% difference is the entire game.
That's a fair critique. But look at the digital public infrastructure in India. Their UPI system and digital ID are miles ahead of anything in Southeast Asia. They are leapfrogging the analog phase of growth. For a tech investor, that digital backbone might be more important than a slightly slower highway.
It's a valid argument, but digital backbone doesn't ship 10 million physical handsets a month. Physical roads do. But look, let's pivot to something even more controversial for our contrarian corner.
I've been waiting for this. What is the mainstream narrative that's currently driving you crazy?
The narrative that the Japan gold rush is a purely Japanese phenomenon. The media is painting this picture of a rising sun led by local innovation and a return to the 1980s glory days.
And you think it's not?
No, it's a safety premium play, Maya. Investors aren't buying Japanese tech because they think Japanese companies have suddenly discovered a secret AI sauce. They are buying it because Japan is the only place in Asia where you can park $10 billion and sleep soundly at night knowing the rules of the game won't change while you're asleep. It's a boring is sexy trade.
Wait, let me rephrase that. You're saying Japan is essentially the Switzerland of techno?
Exactly. The low-risk, high-reliability, mid-range growth haven. The contrarian move here is to realize that the moment China's regulatory environment stabilizes, even slightly, all this safety capital will flee Japan and head back to the 3 times higher returns in Shanghai. The Japan rally is a bet on continued instability elsewhere, not on Japan's own brilliance.
That is a cold, hard take, Alex, but it's one that investors need to hear. If you're in Japan for the innovation, you might be disappointed. If you're there for the safety, you're in the right place, for now.
Precisely. Risk is always relative. Now, before we lose our listeners to an existential crisis about their portfolios, let's give them something they can actually use. Action items for the final week of 2026.
Action item 1. Look at the energy arbitrage in ASEAN. If you're betting on AI, don't just look at the chip designers. Look at the companies that have secured direct power purchase agreements in Vietnam and Malaysia. In a world of 500 megawatt data centers, the person who controls the electrons is the one who controls the margins.
Action item 2. Diversify your India play. If you're only in the big Nifty 50 tech names, you're buying the hype. Look at the specialized logistics and last-mile infrastructure providers in India. They are the ones who will benefit whether it's Apple, Samsung, or a domestic Indian brand that wins the manufacturing war.
And action item 3. Keep a very close eye on the BOJ's February forecast. If they hint at a 1% rate hike by Q3, it will trigger a massive reevaluation of the tech carry trade. You need to have your exit strategy or your hedge ready before that announcement hits the wires.
Data is the only hedge against volatility, Maya. I think we've given them enough data to chew on for at least 7 days.
I think so too. Next week, we're going to be diving into the deep-sea mining race in the South Pacific. We'll be talking about why certain tech giants are suddenly very interested in the bottom of the ocean to secure their 2030 mineral supplies.
It's a race to the bottom, literally and figuratively. I can't wait to be cynical about it.
I'll try to keep it optimistic, as usual. Thanks for listening to Asia Tech Macro. Make sure to hit that subscribe button, check our show notes for the analyst citations, and we'll see you next week.
Stay data-driven. See you next week.
Bye for now.
Goodbye.